Mike Swanson here. I run the website WallStreetWindow.com, and the odds are you're watching this video because you got an email from me notifying you that was just posted by being a member of my email list. Now, if you're not on the email list, click the link associated with this video because you'll want to get on it. If you're watching this video randomly from YouTube, then click the subscribe button and then click the bell with the video on YouTube, and then YouTube will send you an alert the next time one is posted up, because we're in a very interesting time in the financial markets. We had a tremendous rally in March, then last week we got hit. Stocks such as Tesla and Apple got hit really hard, and the S&P 500 fell down to its 50-day moving average. Now that drop to that technical level suggested that we would get a bounce this week, at least into this Federal Reserve meeting that's happening this Wednesday, in just this afternoon, in fact. But what about after that? What is really going on? To investigate this question, I contacted and spoke with Ike Iossif, who runs the website marketviews.tv, because I wanted to get his insight into what his money flow indicators are saying. These are proprietary indicators that Ike created himself. They enable us to see whether there is more buying or selling actually going on in the market and how these levels are changing. And no surprise, there was more selling than buying last week. But these indicators are now doing something that they have never done before. Something very interesting, and you got to see it for yourself. So 1 second, and I'm going to load up the chart with these indicators Ike sent me, and we're going to talk with Ike himself. That's Ike Iossif of marketviews.tv.
Hello, Ike. How you doing today?
Good, Mike. How about yourself?
Oh, I'm doing fine. And you sent me a really fascinating chart of the S&P 500 with your proprietary indicators, your inflows and outflows indicators. And I should say, when we last spoke, you were having a target of 3,500 on the S&P 500. I think we spoke in June or
it
middle.
was actually May 31st.
Oh, okay, May 31st. And we hit that target right going into this month, and now the market's pulled back. So I'm curious what you think is going to happen next, and what are your indicators showing? Because they're showing something really fascinating.
Well, Mike, there are two things that really have my attention. One is the 50% level is the equilibrium level. This is the level at which the dollar value of the up volume and the dollar value of the down volume is equal, okay? The point of reversal very rarely takes place right at the 50% level. It happens somewhere between 49 and 51. The last few months, we have had 3 consecutive reversals right from the equilibrium level. I have data going back 30 years. It has never happened before. It looks like as if an invisible hand, every time the market was ready to roll over, pushed the buy button and things reversed to the upside. It looks rather unnatural. Nevertheless, it is what it is. But I'm telling you, I have this indicator now for the last 20 years, and I have data for 30 years. It has never happened before. The next thing that has also my attention is this. We run a 25-day and a 50-day moving average on this indicator. What we're looking at is the 25-day.
Okay.
Like 5 week, okay? So these are slow moving averages. They don't change overnight. What I had said back in May, that given where the indicator was, which was at the equilibrium level. And I said, if it goes back up to the 55, 60%, we can extrapolate how many points of gains that will amount to with regards to the S&P. And at the rate of increase that we had at the time, then we could estimate that if things continue the same way, the S&P would get up to about 3,500. We got up to 3,570. Now, as I have said other times in the past, that once the target is met, then we have to see where the indicator is at that point, and then recalculate the next target. Now, what we have seen here is that we have a divergence. We got down to the equilibrium level with the S&P at 3,500, and that was August 31st, I believe, or September the 1st or 2nd, just a couple of weeks ago, 10 days ago. And at that point, we could estimate if the indicator had another bounce and got up to the 55, 60 level, 60% level, what upside target we would get. Well, the target we were getting was 36.75 to 37.80 on the upside, and if it turned negative, we had a downside target between 32.50 and 31.50. Now the indicator bounced, but that bounce was very small. We only got 2% gains. From 3,500, we went up to 35.70. We turned back down again. And as we speak, is once again very close to equilibrium. And the S&P is at 3,400. So we need to lower by 100 points, both our upside target and our downside target. From where we're at right now, if we get a reversal to the upside, and this indicator run back up to the 55%, 60% level, well, then we can expect a rally in the S&P over the next, 6 to 12 weeks, up to 35.75, 36.80. If it turns negative and it falls to 45, 40%, then the downside target is no longer 32.50, 31.50, it's 31.50, 3,050.
Which that's where the 200-day moving average essentially is.
Which is very interesting, isn't it?
Mm-hmm.
Because this indicator is saying that if we do not get a reversal here to the upside and cash flows turn negative, there is the potential to go down to 31.50, 3,050. You look at the chart, well, that's where the 200 moving average is at. I cannot make a prediction whether it will happen or not, because one thing we cannot do is we do not know if cash flows will reverse either to the upside or to the downside. All we can do is make a prediction based on the direction they are going. If you had asked me 6 months ago, if we had a similar setup, I would tell you, well, with this kind of divergence that we got, more likely we will see a negative crossover. But the last 5 months, we had this incredible reversal right at the equilibrium point for 3 consecutive times. So who knows, that invisible hand may push the buy button once again.
Well, you Mark, this is the first time that's ever happened. What do you think that means?
There's two explanations. I favor the second. The first one, at first glance, you can say that it's manipulation. Okay, just when the market was getting ready to roll over, the forces to be came in and supported the market. That's the easy explanation. The other one, which I prefer because I like to look at things in a scientific way, is this. I have said before that the reason why I came up with this indicator is because at one time it occurred to me that if somebody places an order to buy 1,000 shares of XYZ stock, that is worth $10,000. If somebody else places an order to buy ABC stock and it's 1,000 shares at $100 a share, that's $1 million trade. Okay, so we're talking two trades. Both of them are 1,000 shares each, but one is worth 10,000, and the other one is worth $1 million.
Right, right.
Obviously, the two can be counted as the same. I think the second one has much more significance than the first. So that is why I came up with this indicator. Now, I'm not the only smart guy. There are many, many smart guys around, and many much, much smarter than me. So I imagine other people are using the same concept, and perhaps they're using it in an algorithmic fashion in connection with other indicators and charts. So when it gets to that level, automatically they start buying. The danger in this is, by the same token, at some point they maybe start selling. So you could get the very same thing, but flipped upside down. But it is very unique. 30 years of data, it has never happened again, and it does look artificial. It makes you wonder.
Well, we never saw the stock market dive like it did in March. We never saw the bond market lock up like it did that month, and we've never seen the Federal Reserve engage in unlimited quantitative easing.
Yes, which all this can explain this unprecedented action by this indicator. You get things, we have things happening that have never happened before, and of course the indicator reflects that. It does things that it has not done before. It makes sense. But as I say, going forward, what we need to keep in mind is that if we have a reversal on the upside, then over the next 6 to 12 weeks, we can see the S&P up to 35.75, 36.80. We get a negative crossover, then the bottom would be somewhere between 31.50 and 30,050. I would be very curious to see how things develop if we got a close below 3,200 in the S&P and a negative crossover in this indicator, because my belief is the combination of two will see an acceleration to the downside. So as long as it stays above 3,200, 3,300, and this indicator is at the flat line, there are chances that the bulls will take control again. A close below 3,200 and this indicator having a negative crossover, then we can get down to 3,050 really quick.
Well, I'm going to follow what the indicator, how it moves and when you update it. So for anyone else out there who wants to do the same, how can they do that?
Well, first of all, they can listen to the interview that you are going to post, or they can visit our website.
Yep, and that's marketviews.tv, and and you post other interviews and pay premium updates too that are very well worth getting.
Thank you, Mike.
Thank you. Good to talk with you.
Have a good day.